Good morning, everyone. I'm Steve Ankerstar. Welcome to the Ankerstar Wealth Morning Show. Today, we're going to talk about one topic and one topic only, and that is the Roth conversion. We're going to talk about different strategies behind converting your Roth, the timing of converting your Roth, what times when you would not convert your Roth, and also we're going to talk about if you happen to be already collecting or having to take your required minimum distributions, then how does the Roth IRA conversion work with that? A lot of people believe you can't do it, but you actually can. So we'll go through that. But before we begin, as a reminder, it's a financial education presentation, and should not be construed as personal financial advice. Full disclaimer is available at ankerstarwealth.com. All right, let's go ahead. And you see Allie there. She did get into the story that she wanted. Bama Rush, 8 days, 2,500 people. Also got featured in the New York Times this morning, an article about some of the drama that went on with HBO Max trying to film a documentary in the middle of Bama Rush there. So kind of an interesting story. Check it out if you are interested. But let's get back to the Roth conversion. All right, the first thing I want to show you here, this is a Kiplinger.com page. If you just Google Kiplinger.com, your guide to Roth conversions. If you're looking at doing this and you're not using an advisor, get your free special report. Kiplinger is a pretty respected name in the personal finance space. So it can, go in depth on your particular situation. If you're not working with an advisor, that'd be a great place to start. But all right, for the rest of us, go to Investopedia and go over some of the Roth IRA conversion rules. So first of all, I kind of think when I talk with clients, there's kind of four different strategies. There's the convert now. It's like, look, we're going to pay taxes on it now. We are going in that way. All our money is going to be in the Roth, and then we're never going to have to pay taxes again. And then once that passes to our heirs, they have 10 years to take it out tax free. So it's kind of like our lifespan plus 10 years, right, of tax-free growth. And then the second one is convert later, lump sum. Say you have a time in your life where you're not earning, or you plan to step away or take a sabbatical, you convert then. Or you could convert over time, which is we'll get into how you actually figure out, if you want to do a chunk over several years, you can do that. And then their last crowd is kind of the never convert. Just leave it as is. So those are the considerations that we will talk about. But let's kind of go through these rules first, and then we will come back to those when those situations would be right for you. Okay, you know that the basic premise is the difference between traditional IRA is that you get a tax break either through IRA contributions or 401k contributions, and you get a tax break, meaning you don't have to pay tax on that money. Now, in a traditional IRA, I like to say the government's a lot of things, but they're not stupid. They let that money grow over the course of your working lifetime. So 4 decades for a lot of people, maybe 3 if you are looking to retire early, 5 if you never want to retire, but really when you look at things doubling by the rule of 72 at 7.5%, things double every 10 years. So is that going to happen if you're sitting in CDs or having money in the bank? No. But if you're fully invested in the market, you can actually look at that market return of that 10 to 12%, which means your money is doubling every 7 years. So over the course of, a 40 to 50 year working time frame, your money could have doubled, 6-7 times, right? So they let it get nice and big, and then at the end they require you to take this minimum distribution and start depleting those funds over your lifetime. Roth IRA is very different. You don't pay, you just pay your normal taxes up front, put your money over into the Roth IRA, and then that money goes tax free. It's never taxed again. It is an amazing deal. It's so amazing that I'd have to imagine somebody someday is going to bring it back onto the chopping block going, why would we be so dumb as a government to to allow for this? But that's not for me to decide because I'm not a politician. You can do partial conversions. You don't have to convert everything. You do have to convert cash. So you sell stuff to cash and then convert the cash from there. But then you can buy the same stuff back in your Roth if you choose. There are income limits associated with each of these. There are traditional income limits, and then there are also for tax deductibility, and then there are also Roth income limits. You can circumvent that with a backdoor Roth IRA under certain conditions. Again, those conditions meaning you don't currently have an IRA, traditional IRA. If you, in that case, you can make non-deductible contributions to your traditional IRA, meaning you're above the income limit, so you don't get it, you don't save on your taxes. But since you didn't get to save on your taxes, you can simply take that money and convert it in short order before it earns any money into a Roth IRA. And then, of course, the only taxable event there is the money that you made. But if you do it quick enough, i.e., you don't invest it, you simply let the fund settle, then convert, there are no gains to be taxed. If you have an existing IRA, that messes that up. And then it kind of depends on your net worth. Should you convert that whole IRA so you can now in turn be able to do the $6,000 or $7,000 a year backdoor Roth IRA? That's generally focusing on too small of an event in relation to your net worth versus whether you, so that should be the last consideration, is whether or not you get robbed of your, or it would re-enable your backdoor Roth IRA by doing so. Excuse me. Okay. You owe taxes on the money you convert. So if you have a $100,000 IRA and you can convert all of it, you tack on $100K of income onto whatever your income is for, say, 2022, if you do it all this year, and then you pay taxes on all of that. Well, a sizable IRA is going to generally bump you up in tax brackets. Now, remember, our tax code is a marginal tax rate. So those are taxes on the next dollar. So it's only the dollars that exceed the next income tax level that are taxed at that rate. So it's not retroactive to all of your stuff. So really, you're just paying higher taxes on a fraction of the stuff you convert. But that is also a consideration. All right, how to do it? It's very easy. You simply can log on and do a Roth conversion from your app. You can have your advisor do it through Schwab Advisor Center if you're with me. You can take the money out of your traditional IRA, like call them up, have them send you a check. You can do whatever you want with the money for 60 days, and then you have 60 days to put it into your Roth. I do not recommend that because life can happen and financial situations can change, and the money might not ever make it over to your Roth. So why would you do that? You can do a trustee to trustee transfer. In other words, that the institution sends a check right to the new institution, or an electronic transfer to where there is actually no paper involved. And that works the best. And then, of course, a financial institution may send you the funds and then you hand them back in, that sort of thing. Where you don't hold on to it for up to the 60 days, you do it immediately. So either way, anyway, you can make it, get the job done. Far more important is the strategy, not necessarily the mechanics. All right, we talked about the tax implications, so I'm going to pause here. When it says Roth conversion limits, there are no limits. Okay. And you can convert multiple times if you're doing the backdoor Roth IRA. Some people are putting in a monthly amount and immediately converting it. You can do that. That's fine. That's a little tedious from a money flow and investing standpoint, but you're the client. So we do what you want. But in a perfect world, I would say try to work your way towards the beginning of the year. The January checklist is write checks for the IRAs and be done with them for the year if you can. Okay, let's talk about the convert now, convert later, convert over time, or never convert math. So if you think that tax rates are going up and your taxable income is going to increase for most of your working, if not all of your working life, and on into retirement, then you want to convert now, right? So let's peel that back a little bit. Are taxes going up? I'd have to say unequivocally yes. We're running a huge deficit. We have historically low taxes right now. I think we would be jeopardizing our democracy if we continue keeping taxes this low. I don't want to pay more either, right? But I do agree that we all have to pay for this deal we've got. Otherwise, it's going to implode. So at some point in time, we're going to have to adult and address that. And that's not a political party thing. That's just at some point, it has to be looked at. So if you think taxes are going up and you think that your income is such that it will probably continue to increase over your lifetime, even after you retire, you have enough passive income coming in where you're not going to get much of a break. You've got income replacement. Maybe you have annuities. Maybe you have real estate kicking off cash. All of those things can mean that you're not necessarily going to make less in the future than you do now. If that's the case, you'd want to convert now. So when would you not want to convert? Well, say that you don't have any of those assets that kick off cash, like businesses and investments in real estate, annuities. Then all you're going to have in retired pensions and all you're going to have in retirement is simply your Social Security. Then your taxable income is low enough to where the required minimum distributions are going to be either not taxed or hardly taxed because you don't have as much income in retirement. I don't want to really get into it with the, FIRE folks, which is the financially independent, retire early folks that want to step away from the corporate world at 30. If that's your dream, hey, execute your dream. I'm not here to tell you your dream's wrong. It's your dream, not mine. I'm just saying there's some risk there in the fact that you can be making it a goal to be broke in retirement. So just realize that your 70-year-old self may not think that that's the greatest idea that your 30-year-old self had. To let's make sure we don't have any income so we don't pay taxes in retirement. But anyhow, that's up to you, your own choices. But just realize that a lot of people think that they're not going to have income in retirement because they're going to step away from their high-paying job. But unless you are kind of a bad investor, you're going to have that stuff, right? So just don't kid yourself, I guess I would say. Or you think that taxes are going down, right? These ridiculous tax rates we have right now are way too high. It should be less, or maybe it should be free. I don't know. If you're right, maybe somebody makes it free someday, and then all these fools who converted to the Roths that will look like idiots. I don't see it happening, but I don't have a crystal ball that tells me the future either. So that would be the kind of consideration for never convert. So there's a lot of people are just another consideration is that, I'm so confused by all this that I'm just going to have two buckets of money. I'm going to have my traditional bucket and my Roth IRA. And then when I get to retirement, then I'll draw them down differently. You can do that too. And for a lot of people that are talking big numbers, i.e. 7 figures and above, for conversions, don't really want to pay a $300 to $400 tax bill. So therefore, they're just like, there's no way I'm doing that. I would rather pay more over my lifetime. It's like, okay, you can do that. The math still holds. But to each their own. But you should really look at this stuff to make the right decision for the totality of your life. If you think you're about to pass away, then no, you wouldn't want to convert all your stuff, pay all those taxes, and then, pass away, but you probably don't know when you're going to pass away, right? So if you do have a time in your future where you are stepping away from a high-paying job or taking a sabbatical, or in my case, and I'll just be open kimono with what I did, is when I retired from the Air Force, I had almost everything in traditional because I'm old enough to where there was no Roth IRA back in the day, right? So converted everything. And I did it over the course of 2 years. I said I was going to start my own business and I was going to not take a salary for 2 years. So I kept my income at zero as far as the business, but all I had was my pension income. And then I converted and it was a sizable amount. I'm not going to lie to you. It hurt to write those checks. But now that everything's in Roth, 10 years later, after the market has screamed higher for those 10 years, I'm pretty happy I did that. But it doesn't feel good at the time. But if you're looking at the long-term math, then you will have no problem executing that strategy. But by doing 2 years, I was able to straddle, and it wasn't a calendar 2 years, it was a tax 2 years. So I retired in October. At the end of October, I converted half that year and then half the other year, right? So I kind of straddled. I actually did a 1/3, 2/3 because I had some of the income. But you're able to get it done pretty quickly, and you can straddle a couple years if you have that option. If you want to do it over time, say you have a $500,000 traditional IRA and you're like, you know what, I know I need to, I hear you about the math that says convert now, but I'm not willing to just pay this ridiculous tax bill. So therefore pick a number like 25,000 or 50,000 and convert it every year. That's one way, is to just pick a round number, if you will, to do that, and know that eventually you will deplete your traditional IRA and it will all be converted. And you've done this peanut butter spread over several years. That's one way. Another way is to pull out the Excel spreadsheet, put in the tax codes and say, okay, I make 108,000. So therefore I can convert, 22,000. That's not the exact number because I don't have the tax code in front of me. But you can kind of say, okay, I will convert every December just enough to not trip the next tax bracket, right? Sometimes that's a little bit, sometimes it's a lot, depending on where you're at, and move forward with that strategy. If you want to take the time to do all that, you can. That's still going to be better, more beneficial long-term than not converting. So that's the convert over time sort of philosophy. And the last one is if you are approaching, you're either in required minimum distribution phase, which again used to be 70.5. Secure Act 1.0 moved it to 72. Secure Act 2.0, if it ever passes, will probably move it out to 75. If you're taking RMDs, you still can convert to Roth, right? And people are like, well, it's kind of getting late to do that. And I'm like, well, it is and it isn't. One reason you can do it is if you want to pay the taxes versus your heirs. Okay. So let's talk about a couple scenarios there. Is say you have 2 children. That's just easier for the math. And it's going to get split half and half, and both of them don't work because they're still in your basement. No, I'm not, wherever they are, but they're not working, so they really don't have much money. So when they get your inherited traditional IRA, they have 10 years to take it out. So they spread that over 10 years, and they're taxed a little bit, but not a tremendous amount because they don't have much income. Okay, that'd be one situation where, yeah, I wouldn't be in a hurry to convert all that money. But because their tax bite's going to be pretty low. But let's talk about those same 2 kids that are now making $250K and above. Well, when your traditional IRA goes to them, they have to take it out in the next 10 years. So say you had that $500,000 IRA, and you're like, that's a good problem, but yeah, that's not an uncommon number in retirement, right? So yeah, in a straight line, that's 50K for 10 years. What's reality? 50K the first year, and then the account grows. And then the next year, if the account grows more than 10%, you're still taking, 50K, right? Because so the totality of those 10 payments is going to exceed 500K, right? Over time, because the account grows while you're depleting it. Or a lot of people are like, ooh, I don't want to pay the taxes this year, so I'll wait. And I'm like, well, all you're doing is ballooning a payment later on, which is the worst thing to do, right? So start, being smart about it. Excel's your friend, or numbers, or whatever you want to use, or pen and paper. But I mean, you need to look at these things, right? So that would be a situation where you'd want to convert if you're going to be in a lot lower tax bracket than your children. And when you pass away, and you're going to sprinkle this on them, and you're going to eat alive for taxes, right? There is a strategy to disclaim IRAs. If you don't know about that, you need to learn about it, especially if you're a high earner that makes over $250,000 a year. You probably want to disclaim that IRA off to your kids. But we can talk more about that later. All right, that is enough for one day. Let me look down here on Roth conversion limits. There are none. Again, if you have a $4 million traditional IRA, good for you. You can convert it all. The backdoor Roth IRAs, we kind of talked about those. 5-year rule they talk about here is you have to have your money in a Roth IRA 5 years before you can withdraw it. So consideration there, if you're just starting with this stuff, don't think you can pay the taxes, move it to Roth, and then withdraw it in the first 5 years. That would be flawed thinking. But then it would be flawed execution too, right? So you want the money you put into Roth, you want to grow as long as possible. So when you look at buckets of money in retirement, generally you want to burn down extra taxable stuff and take the minimum distribution you have to out of your IRA and let the Roth grow forever, and then pass it off to your heirs, again, tax-free. So that's kind of what your thought process is there. Does the Roth IRA conversion make sense to you? Well, it depends on your situation. I think mathematically, if you assume that rates are going up, then yeah, a conversion makes sense. But you have other things going on in your life that you need to either figure out on your own or talk to somebody. So that's all we have for today's show. I enjoyed doing just one topic for all day, but so I started putting together like all the different scenarios, and I'm like, oh my gosh, this is going to be too long to try to cover with other things. So thank you so much for this question, and submit your questions and comments through social media or directly to our email at VIPservices@Ankerstar Wealth. Don't forget to like and subscribe, and that's all we have for today's show. I'm Steve Ankerstar, and we will see you back tomorrow.